If expected return and systematic risk are related, if expected return is based on the level of systematic risk, and there's a couple of questions we need to answer. And the first one is, how do we measure systematic risk? How do we go about measuring that? And the answer to that question is with beta. So that's the actual Greek letter. Actually, it looks like B, beta. What is beta? Beta is a measure that captures how the returns of an asset or a portfolio, it's relevant for either, how they tend to compare to the returns of the average asset in a particular kind of circumstance in response to news that affects the returns of all or virtually all assets. So news comes out, and we'll make that the zero line, and the average asset, tends to, is up. Beta will tell us what a particular asset or portfolio is likely to do. Is it likely to be up? Is it likely to be up higher than this, lower than that? Is it likely to be down? That's what beta captures. So a beta greater than zero, a positive beta, means that there's positive systematic risk. And what that means is that an asset's price tends to change in response to this macroeconomic news that affects everybody in ways that are the same direction as the average asset. So let's say news comes out and the average asset says, hey, that's good news. Then if a stock has a positive beta, it would also tend to have a positive return that day. Next day, news comes out that the average stock would interpret as bad news, so the average stock price tends to go down. Then a stock with a positive beta would also tend to have a negative return as well. So positive systematic risk means it's kind of a similar reaction to the news as the average stock. What if we have a beta equal to 1? Well, it's positive, so it's greater than 0, so it's positive systematic risk. But what's important about beta equal to 1 is that's an average level of systematic risk. So beta of 1 is our benchmark. And what that says, it's positive, so the changes for a particular asset with a beta of 1, since it's positive, will tend to be in the same direction as the average asset. But the beta of 1 means not only is it the same direction, but it tends to be the same magnitude. So news comes out on a particular day, average asset interprets it as bad news, is down by a certain amount. Well, a stock with a beta of 1 would tend to be down by the same amount. Next day is news that's considered good news, so the stock would tend to be up by a certain amount. Beta of 1, stock would tend to be up by the same amount. And again, important to remember that beta of 1 is an average amount of systematic risk. It's a very important benchmark. Let's talk about an important concept, the market. Sometimes it's also called the market portfolio. It's all assets in the economy. So conceptually, it consists of every stock, every bond, every piece of real estate, every jewel, every natural resource, every new and used car, every piece of clothing, every piece of artwork, all assets in the economy. Typically, we can't really measure every single asset, so we'll use a broad stock market index to represent the market if it has lots and lots of stocks, particularly out of the large ones that are involved in activities in lots of different areas, lots of different businesses. It's a good proxy for the overall market. One of the most common is the Standard & Poor's, the S&P 500, which consists of 500 leading companies, essentially the 500 largest. And so there's pretty good coverage there as far as the overall economy. When we talk about somebody holding the market or someone owning the market portfolio, it doesn't mean that they are a super rich person that owns everything. It means that their portfolio is allocated in the same way as the overall economy. So suppose the economy only has stocks and bonds and real estate, and it's 50% of the world is bonds, 30% is stock, and 20% is real estate. If the person has a $100 portfolio, then it's 500, 20, and 30. It's the same proportions as what exists out there. This concept isn't as important for Finance 301, but becomes very important for kind of investments as people want to take a, a portfolio that mimics quote unquote the market. But anyway, if you hold the market, you hold a portfolio that has the same proportion as everything. And the market portfolio has a beta of 1. So the market portfolio has an average amount of systematic risk, and that should make sense because a combination of everything, by definition, is average. So, average kind of captures typical of the group. Well, if you have the entire group, it is the whole group, and so it's going to be average. And the market portfolio is beta, and then the subscript is a capital M, and that's equal to 1, and that's an average amount of risk. So the beta on the market, the beta on everything, the systematic risk for everything in aggregate is average, an average amount of systematic risk. How about if beta is greater than 1? Well, it's positive, but it's greater than 1, so it's above average. And what this means is an asset's price will change in the same direction, but the magnitude will tend to be greater than for the average stock. So here's our kind of our zero line that we've been putting in. Average stock says, hey, that's good news. A stock with a beta greater than 1 would say, not only is that good news, but it's great news and would tend to have a higher return that day. Next day, the news comes out, the average stock would tend to be down, say it's bad news. A stock with a beta greater than 1 would not only tend to be down, but it would tend to be down by a greater amount. Stocks that are of firms that would typically or commonly would have a beta greater than 1 would be one if they have performance that tends to vary a lot with economic conditions. Banks, luxury goods sellers. So, for example, a bank, if the economy is doing well, more people take out loans. The people that have loans are more likely to pay them. So, if news comes out that suggests that the economy is going to be stronger than previously thought, then that's good news, but it's extra good news for the bank. Likewise, if news comes out that's considered to be particularly bad, the average stock says that's bad, it's going to be extra bad for banks, meaning fewer people can pay their loans and fewer people are going to take out loans. Same thing with luxury goods sellers. That's the first place people tend to cut if they're concerned about the future, and that's one of the first places that they start adding to if they're optimistic about the future, and so they're going to be more sensitive. How about a positive beta that's less than 1? So here we have below average systematic risk, but it's still positive. It's still greater than 0. And so here you're going to tend to get price changes that are of the same direction as the average asset, but they're going to tend to be below average in magnitude, less than the average asset. So news comes out, average stock says, wow, that's good news. A stock with a beta between 0 and 1 will say, you're right, it's good news, but not as good for me as it is for you. Same thing, the next day, bad news comes out, average stock is down. A stock with a beta between 0 and 1 would say, yeah, that is bad news, but it's worse for you than it is for me. What are some of the kinds of companies, the kinds of stocks that one might expect to have a beta between 0 and 1? Their firms, the performance does vary with economic conditions, but by relatively little. And so common ones would be pharmaceutical companies or grocery stores. Pharmaceutical companies that there's, as the economy strengthens, more people would have money to buy their necessary medications or have jobs to have the health care to afford those. But when the economy weakens, well, you're going to lose some of that. There's a lot of folks that are taking medicines that no matter what the economic conditions, they're going to take it. So as the economy ebbs and flows, drug sales will ebb and flow too, but by less than the overall economy. Same thing with grocery stores. Everybody's got to eat. Things are going real well. More people have money to eat, and so they can maybe buy more steak and lobster. So news comes out that the economy is going to be weaker than expected. That's bad news for the average stock. For grocery store, it's bad news, but not as bad because they know that people still have to eat, and so instead of selling maybe high margin lobster, they'll sell lower margin peanut butter. So those are some examples of some companies that would have a beta between 0 and 1. Beta of 0 is no systematic risk. There's no relationship between the news that comes out that affects, the average. There's no relationship between the return that an average asset has in response to this macroeconomic news and the return of an asset with a beta of 0. And so if the average asset, let's say, says, hey, that's good news, if you've got a beta of 0, you could have kind of any kind of return. Same thing with bad, you could have any kind of return. The other kind of asset that has a beta of 0, we'll talk about in a second, is a risk-free asset. So the risk-free asset, by the name, it has no risk, and by definition what that means is that the unexpected return is always 0 and the actual return always equals expected. If we're told that the risk-free rate, or the rate on the risk-free asset, is, let's say, 3%, no matter what happens, no matter what news there is, it's going to get 3%, 3%, 3%, 3%, 3%. There's absolutely no volatility, and therefore, and so we don't actually have in the real world a true risk-free asset. The closest we have is short-term Treasury bills, U.S. Treasury bills, short-term, very little interest rate risk. If yields did happen to change, the price wouldn't change by much. And T-bill rates, meaning that there's very little to no default risk. And so the rate on those is what's commonly used as a proxy for the risk-free rate. The risk-free rate has a beta of 0, and we denote it by a beta with a little subscript of F for free. And if you think about it, news comes out, average stock is up, risk-free rate gives you the risk-free rate. Next day, news comes out that's bad. Guess what? Risk-free rate's giving you the risk-free rate. More bad news the next day, risk-free rate's the risk-free rate. So it doesn't matter what the news is. It doesn't matter kind of what the average asset's doing. Risk-free, always giving you the same thing. Beta of 0, same return. Finally, if you've got a beta less than 0, you've got negative systematic risk. And if you've got negative systematic risk, the change in an asset's price tends to actually be the opposite direction as the average asset. So news comes out, average asset says, wow, that's good news. A stock with a beta of 0 would say, that's good news for you, but it's bad news for me. Next day, news comes out, macroeconomic news, that's considered, bad news, so the average stock has a negative return. A stock with a negative beta would say it's bad news for the rest of you, but for me that's good news. So it's the opposite direction. And the strength of that is the magnitude of beta. So if you have a beta of negative 0.1, then if the average stock's up by 1%, then the stock with the negative beta would have a negative return, but relatively small. If it has a beta of negative 5, if it's good news and the average stock is at plus 1%, then the stock with the negative beta, the beta of negative 5, would be way, way down. In this class, we don't focus on assets with negative systematic risk and negative beta. Couple of reasons. Number one, assets with negative beta, they're rare and uncommon. As an investor, if somebody wanted to invest in an asset with a negative beta, typically they would have to buy something that was essentially manufactured on Wall Street. The other thing is, by us focusing on non-negative betas, positive betas and zero betas, it allows us to discuss risk in a way where we can involve a lot of math and probability. Once you throw negative betas, you got to ratchet up the discussion, and we can avoid that. So we don't spend much on negative betas in this class.